Hi, welcome to My Divorce Real Estate. I'm Amber Gifford, and this is my husband and teammate, Scotty Gifford. And today, what are we talking about?
We're continuing our tax talk.
Ooh, taxes. Boring.
Boring, but important.
Very important. So, last time we talked about capital gains, which revolves around real estate, something you need to know.
Yeah, that's a very big one, and so that's why we did a whole separate video on that one. And this one, we're just going to give you the rundown of basically there's 8 different tax implications that can be happening for if you're thinking about divorced and what those could be.
So you talked about in the last video. We're just going to run over them really quick with you so you can be in the know, because knowledge is power, right?
Absolutely.
So the first thing we're going to talk about when you are getting a divorce is the timing of your divorce.
That's right. So you're either married or you're not in the eyes of the tax man.
Correct. So if you're filing or having a divorce at the end of the year, maybe you're in an amicable situation with your soon-to-be ex and you both jointly decide, hey, let's get through the end of the year as married and file, as opposed to divorcing now. So totally up to you and up to your tax advisor if you have one. But the timing of your divorce is key.
If you get divorced before the last day of the year, December 31st, then you would be considered divorced and not married that year.
The other is going to be the possibility of joint returns. Let's be real. You're divorcing this person for a reason. Do you really want to be in a joint return?
Yeah, it depends. Maybe you do, maybe you don't, right? So that's a very complicated topic, that one. So that one's definitely want to get connected with the CDFA and help you make an informed decision about whether you want to do the joint filing or not. So
yeah, I mean, if you didn't trust them before, maybe trust has been broken more and whatever.
Yeah, we have some scary stories about people that did some joint filings together and then tax implications for a decade afterwards. So
yeah,
that's
it's something that to discuss, but just keep in mind if you're going to be filing jointly, what are your motives there? Make sure you have someone to look over it before you file with the IRS as well.
Mm-hmm.
Dependency deductions if you have children, not pets, children.
I know you want to claim your pet as a child, but only children count.
Only children. So you need to be thinking about that as well. And going forward, too, who's going to get those children as a tax deduction on their return? Mm-hmm. What's the rule?
So usually, I mean, well, you can decide anything you want, right? You can say we're going to take one a year, vice versa. You can decide anything you want. But usually what it comes down to is do you have that child, 180 days plus, right? So.
And then that deduction becomes yours.
Mm-hmm.
Again, it can be negotiated as well. So the fourth thing is going to be your asset transfers at divorce or business?
Yeah, businesses, like if you have a trust or anything complicated, like other assets that maybe fall under businesses or...
I do want to say, if you have a business, as we do, together and you are going to be filing for divorce, I highly encourage you to get a divorce attorney who specializes in marital properties that own businesses or multiple things, because they do have expertise in the division of a property and a business property, not only the actual brick and mortar, but the liabilities, the assets, what you earned, everything. So I would recommend finding an attorney that specializes in that. They're out there.
Yeah, definitely something you want to look into.
And we can get you connected to them as well.
The one that's usually probably more common than the businesses is going to be 401ks or IRAs or other retirement accounts.
So 401ks, your spouse could be entitled to a portion or all of your 401k. If there's some sort of buyout, they owe you money for settlement, they can give it to you in the means of a 401k, which is separated by a QDRO, Qualified Domestic Relations Order.
Amber's got expertise, done those before, right?
I have, and I had one myself. So if that's something you're going to be doing in your divorce, talk to your attorney about it. They usually outsource this person. It's rolled over into another 401k into that person's name. If you're going to be cashing that in, you do have to pay taxes on that money. So be thinking about what time of year you get this, and as long as it stays there, you're not taxed. But if you do disperse those monies, you will be taxed on that as well.
Yeah, the only thing I want to add to that is you're going to be taxed on income, though, but you wouldn't be penalized for the 10%
Correct.
early withdrawal if you didn't put that in there,
So
right?
the purpose of a QDRO is to not have that 10% penalty fee that you get if you were to take out your money out of a 401k. So if Scotty were giving me some of his 401k because we were divorcing, he would not be penalized 10%. I would be receiving the money in an account similar like a 401k in my name. If I chose later to take that money out, then I am taxed as income, not 10% penalty fee. So make sure you know that and your CPA knows that as well.
Yeah, that's good. That's good. She's very good on that.
So now we're on number 6.
6. Yeah, so we're talking about the capital gains ones. We did a whole video on that just before, but basically we'll kind of summarize that, you get $250,000 as an individual, a $500,000 exemption if you are a married couple. The rules for that, you got to be living home 2 of the last 5 years, and to get the exemption either way, and then you have to be married and both be on title to get the exemption to the $500,000.
There's a lot of info in our other video on that, so please watch that as well.
We'll link to it above. The number 7 is child support.
Ooh, yeah, if you're getting child support. It is not taxable, just so you know. The receiver obviously you earn income and you're taxed on that, but there's no additional tax on child support.
Yeah, so let's just go over an example. So we're both divorced and now remarried happily. And so I pay child support to my ex-spouse, and I have to earn income on that. So I'm actually paying income tax on that, but she doesn't pay any income tax on the money she receives. So it's not a taxable event for her. And there's no deduction on my part for paying child support. There's just the tax consequences of just earned income, right? So
correct. And next,
spousal maintenance. So number 8, the last one. So spousal maintenance are.
In Texas, they usually don't say that you get like spousal support or alimony. They can code it as that. It depends on your situation. They can say it's a settlement on your behalf, and then they code it under alimony. After 2019, you no longer as a receiver are taxed on that money.
So it kind of falls back into the same category as child support, right? So it's not a taxable deduction for the payee and not a tax
income tax any longer. So anything after 2019.
Now we do have on our website, we have a couple calculators, the buyout calculator, which I think is very useful, but we also have child
support.
Yeah, not a child support, but a spousal support calculator on there too. It's not required in the state of Texas, but usually what kind of the general guidelines would be if you're married 10 years or longer. And then if you also, based on your income, it kind of breaks it down to you what that would be, bases off of 20%. So it's on there. You can check it out too.
Our website is www.thegiffordgroup.net. And if you want a free divorce resource at mydivorcerealestate.com.
Yeah.
You going to add anything else?
No, I think that's a lot to cover.
Thanks so much for watching. And as always, Scotty and I are here to bring you real life experiences to all your real estate needs. Take care.
Bye now.